In some of my previous videos, I had discussed different aspects of the Nigerian VAT system. I had discussed the difference between withholding tax and VAT. I'd also discussed the circumstances under which a recipient or purchaser of taxable goods or services will be required to remit VAT to the Nigerian Revenue Service. In this video, I'll be talking about the concept of input VAT and output VAT, and when input VAT can be claimed from output VAT. Input VAT, in simple terms, is the VAT that a business pays to its suppliers or vendors for goods or services supplied to it. Output VAT, on the other hand, is the VAT that a business charges its customers for supplies it makes to its customers. So if we're to take a hypothetical business that sells perfumes, this business will be required to pay VAT to its suppliers. So if the business had received supplies worth 10 million naira in a month, they will be required to pay VAT of 7.5% on that 10 million. That VAT that is paid by the business to their suppliers is called the input VAT. Now, when it sells the perfumes to its customers, it is also required to charge the customers VAT. And that VAT it charges its customers is called the output VAT. Under Nigerian law, presently, input VAT is deductible from output VAT. What this means in essence is that the VAT that is paid by a business to its vendors is deductible from the VAT that the business charges its customers. So if this business had paid VAT of 1 million naira in the month of January for supplies that were made to it, and then it also charges VAT of 1.5 million on supplies that it had made to its customers, the business will be entitled to deduct 1 million naira from the 1.5 million naira that it had collected from its customers as VAT, and remit the 500,000 naira to the Nigeria Revenue Service, because the output VAT is more than the input VAT that is charged. However, it is not in all cases that output VAT would be more than input VAT. So it's very possible that in this same month of January that we talked about, the business could have paid input VAT of 1.5 million and then charge output VAT of only 1 million. If that happens, because there is no excess output VAT to remit to the Nigeria Revenue Service, the business for that month would not be remitting any VAT to the Nigeria Revenue Service. But that is not even the end. The business would also be entitled to claim a refund of the excess input VAT that it paid to its suppliers, which in this case would be 500,000 naira. It can claim a refund or utilize the 500,000 naira as input VAT credit for subsequent months. The new tax laws actually provide a very wide scope for deduction of input VAT. As a matter of fact, input VAT that is paid by a business on services and fixed assets are also deductible. This provides a much broader scope of deductibility of input VAT than what obtained under the VAT Act. So in summary, input VAT that is incurred by any business can be deducted from the output VAT that the business charges its customers. And if you find that the input VAT that you suffered in a month is more than the output VAT that you have collected from your customers, then you would not be required to remit any VAT to the tax authority for that month, but you can utilize the excess input VAT as credit for subsequent months. This is ASA's Tax Corner, simplifying tax issues for businesses and individuals.